Aaron Swisher is here because you, AVID investors, have asked for an economist speaker, and you specifically set in a feedback form with both national and local knowledge. And with the recent changes in interest rates and the economy affecting things, we have new questions. And so Aaron is a longtime Idahoan, and he's got an economic savviness, and it inspired him to author the book, Resuscitating America. And it's outlines the cause and effects and problems, and he puts pen to paper and takes nonpartisan solutions. I stole some of this from Amazon, sorry, but he puts them to some of the major economic problems that our nation faces. And so he's our feature presenter, and in having spent all of that time trying to solve the greater macroeconomic problems that he sees, he even ran for Congress and put a lot of pressure out there and got his book out there and got some ideas out there. So I know that this is your area. You've got a lot of knowledge to share. And so come on up, Aaron. Thanks for being here.
What's my forward and back?
Forward
and back.
backwards.
Simple enough.
Yeah, and then you might stand on this side right here where I was.
Okay.
And that way maybe they can see this slide.
Okay.
And
And
then
I might I'm not only crippled, but I'm blind, so I wasn't sure I was going to be able to see the thing in the back. Well, if you ask an economist to come speak to you, you must be having some sleeping problems, right? Hopefully I won't bore you to death. Everybody wants to know what's going to happen with interest rates, right? I mean, that's the name of the game in real estate. Unfortunately, I didn't, the way I organized this, that answer, or that potential answer comes a little later in the talk, but I'll try to get there as fast as I can. The first thing I want you to do is kind of think about the real estate market and your real estate decisions, similar to how you would an equity investment. Right? You've got the national economy, or kind of the national market. Are you in a bull market or a bear market? Right? That's kind of what we're looking at with interest rates and inflation and that type of thing. But then when you go to pick individual stocks, you want to be in the right industry, right? And we could think of that as a regional market or a state market, right? Because some states are better than others. And then, of course, your individual properties would be like equities, right? My point being is that no matter what the interest rate is, no matter what inflation is or the overall market is doing, you can always find diamonds in the rough. So don't think, well, interest rates aren't exactly where I want them to be, or the pricing isn't exactly where I think it should be, right? You can always find a property that may be worth buying, regardless of what the overall market is doing. Fair enough? So of course, local market decisions, and of course, these trump everything else, right? Location is, that's what real estate's all about. Finding comparative values. How much is, land costing me here, dollars per acre, versus over here, dollars per acre, right? Does this look like a good deal versus everything else I'm seeing? And of course, looking at just the local economy. Are there jobs around, right? Like Boise is a place where businesses seem to be moving in, so that makes it a good market. Local and state regulations play a role in that. And then, of course, I probably should have put on here supply and demand, because I'm sure what we're seeing here is much different than maybe what you're seeing in Florida. State and regional issues, like I say, these are like industries. You want to be in the right industry. I would not be buying in Florida. I think they've got an insurance disaster there looming. Are people aware of that or no? Maybe, kind of, yeah.
What is that? What's an insurance disaster?
So basically, and I won't get the names of the hurricanes right, but, maybe 5 years ago, a hurricane came through Florida, wiped a lot of stuff out, and a lot of the companies that were providing homeowners insurance said, we're not going to be in this market anymore. And they pulled out. And the state of it got bad enough that the state of Florida said, well, we're going to come up with like a kind of a government solution, government offered mortgage insurance or homeowners insurance, right? But there's only that only covers a certain price range. And the homeowner in the insurance companies that stayed in the market are typically being covered by a reinsurer. So like an insurer for the insurer, right? Now that Ian has gone through, like those claims are still kind of being processed and coming through. But once those go through, you may have a market where all the insurance companies or the reinsurers say, we're not going to cover that market anymore. And the only people that are going to own real estate in Florida are the folks who can afford to like just take a bath and have their property worked out, right? Wiped out, because you're not going to be able to insure your property. You know,
I think Florida, the state coastal areas are already 70% state-backed insurance or higher.
yeah, it's a mess. And, you know, maybe you believe in global warming, maybe you don't. But the fact of the matter is, like, Florida is probably going to get hit by another major hurricane sometime in the next 5 years. And I'm not sure there's going to be any insurers there after this latest storm, you know.
Well, and in terms of jobs, you mentioned jobs. Shane, what's Micron doing?
Right now, well, they're building a mega fab.
Here.
Boise. Yes. Yep. So they got a bunch of money from the government. So it's, I think, $15 billion from the government to build and fill a fab.
Yeah.
In Boise. So a production fab.
It's a lot of jobs. It's a lot of decent paying jobs, right?
Yes.
You know, you can debate whether or not they pay enough, but they pay better than a lot of jobs. So that's, you know. Yeah. Southwest United States. My wife actually, her company got bought by another company and they told her they want to retain her, but they want her to move to Phoenix. Of course, I'm not moving to Phoenix. I don't think my wife wants to move to Phoenix, but part of me wanted to say, like, why do you want people to move to Phoenix, right? You guys don't have any water. You're going to have no energy, or what energy you do have is going to be super high priced, right? It's 120 degrees in the summer, right? Like that's just not going to be livable, I think, you know, in the next decade, right? Like that's not a market I'm buying. Just like if you were thinking about equities, right? There's some industries you just don't want to be in, right? Like the buggy whip industry, you know, like get out of that, right? Boise is a good market, right? I should have had a comma after the Idaho, because I'm really thinking not of Boise, Idaho, but Boise, Idaho, and the Northwest. Like this is a good regional place to be. At least for now, we have water that may become a problem, you know, in the next decade or two. But it's certainly not looking like the Southwest. Depending on where you're buying, you do have to consider things like forest fires and stuff like that. But, you know, overall, this is a good place to buy. Okay, so those things do always trump the national environment, right? You can find diamonds in the rough, even when things are not going the way you think they should. And of course, Stacy alluded to this, and you all probably know it, right? Higher interest rates tend to bring lower housing prices, right? People can't afford what they could when interest rates were lower, right? They're just paying more per month because of the interest rates. And so that puts downward pressure on the market. And of course, higher inflation brings higher interest rates. So everybody wants to know what is going on with inflation, right? Where's that going to go? Where are interest rates going to go? The reality of this situation is nobody can tell you, right? Even the folks at the Federal Reserve don't know what they're going to do with interest rates next month. That's why they meet. They have an idea, right? Like every economist can give you an idea or a guesstimate, but no one really knows. So let's talk about inflation real quick, where it comes from, what drives it, and what is driving it presently. At its core foundation, inflation is simply a matter of money versus production, right? If you are growing the money supply faster than your society can grow its production of goods and services, you will have inflation. And what I put on here was a money supply graph starting in the early 70s. I did cut it off at 2019, and I'll explain why that is in a little bit. But you can see, like, we've had money growth at some rate over this time period, but it has accelerated massively over that time period, right? And we did have like very high inflation in the 70s, but then really for most of this time, we haven't had inflation. I mean, a little bit, but not, 2 or 3%, maybe 4, bump up to 5 and then down again, right? Not your double-digit inflation that we had in the 70s, not your 7 or 8% that we're having now, right? So where has the inflation been? One of the things that a lot of people don't realize is that there's always inflation, but economists just don't look for it in the right places, right? When economists measure inflation, they're measuring like consumer goods, computers, bread, milk, eggs, cell phones, that type of thing. So let me ask you, are housing prices part of an economist's inflation measure?
Maybe you're saying they're not.
They're not.
Wow.
They're not. Why not? Because economists consider housing an asset, just like equities. They don't measure stock market prices either, right? Where has the inflation been for the last 2 or 3 decades? Equities and housing prices, right? They're just not measuring it. But we live in a society that's got a lot of income disparity, right? So the folks at the top have a lot of extra cash. They're pulling in all the extra cash. What do they do with that? They buy stocks, or in some cases, housing, right? The other thing we notice is that the Fed has kept interest rates really, really low for like a long period of time. And when you keep interest rates low, the biggest effect is on the long end of the yield curve, right? Like a 30-year loan is going to, as interest rates drop, you're going to get your biggest bang for the buck on that longer loan. What do you buy with long-term loans? Housing and college, right? You get a 30-year college loan, you get a 30-year housing, mortgage. Not always, they've got some differences, but typically, that's where your long loans are going. So that's where you see a lot of inflation. Housing prices, college tuition. Of course, college tuition is part of the inflation measure, but it's really just a small part. Okay, so lately, though, we have seen inflation, right? We haven't seen inflation really for a couple decades, but now it's starting to rear its head. So the question is, why now? Why do we see inflation now? And we haven't seen it for the last few decades. Part of that is an income disparity story. But part of it also, I think, is we've got some triggers, okay? I'm going to move to my next slide real quick. This is the same money supply graph as I showed just a couple minutes ago, only this is from 2000 and it includes up through 22, right? Or where we are so far. You saw the increase on the other graph, right? That is hardly noticeable here. I mean, this is it. This is that same increase, but the increase that we've seen since the pandemic, they have inflated the money supply so much that is hardly even noticeable. There is a ton of money out in the market right now. So that may be one of the triggers. And of course, you can see they're starting to pull that back in, right? How much they will pull it back in, who knows? And if they don't bring it down too much, that's really probably going to be a great thing for housing in the long run, right? Because it will keep interest rates low or abnormally low. And that, drives money into housing, as I was mentioning a little bit ago. We do have some other triggers beyond the flood of money. We've had some supply chain disruptions, right? COVID, particularly in places like China, has really disrupted parts that go into a lot of things that we make, right? So it's kinked the supply chain. You don't have much supply. You still have the same amount of demand that drives up prices. Fair enough. War in Ukraine, right? Still, that crimps like oil and gas prices, wheat prices, and those things tend to drive up other prices. Corporate greed and profits. Over half of the inflation increase that we're seeing today, 54%, is going to corporate profits, right? Like if you read the news, they would have you think that, hey, we have to start putting some people out of work so labor prices come down because that'll bring down inflation. The smallest factor right now in inflation is wages and labor costs. The number one thing is actually corporate profits. And then of course, the second highest thing is your, what you would call cost of goods sold, your inputs, right? So, during the last administration, we had a corporate tax cut. If you cut taxes for corporations, particularly on the top end, right, there's an incentive to go out and drive up prices, improve your profits, right? That type of thing. The way things are looking right now with the election, we're probably going to have a divided government. So it's not like they're going to take those taxes back up. And so that could be something that keeps inflation around for a while. And then finally, like I mentioned, labor costs, increases in wage rates. In some cases, you can have what Stacy was mentioning from the other economist, a spiral where people are increasing wages to meet inflation. Of course, they have to keep their profit margins up, so that drives up prices to keep the profit margins high. You just have this upward spiral. So this is what you want to know, or this is what you want to look for, right? Everybody wants to know where interest rates are going, where's inflation going. This is what you want to look for. You want to look for something that reverses those triggers, okay? And into the war in Ukraine and into the pandemic and a loosening of those supply chains. We probably are not going to see an increase in marginal corporate tax rates, but if you did see something like that, I think would have a great effect on bringing down inflation. And then of course, a recession, right? The Fed just drives up interest rates so high that we fall into a recession that kills demand, inflation falls, and that's typically how things are done. The important thing to know, regardless of what happens to inflation, is that only one of these things is probably going to bring down interest rates. Let's say the war in Ukraine ends, the pandemic ends, inflation moderates, comes down to 2%. The Fed likes that. That doesn't mean the Fed is going to lower interest rates. The Fed has had interest rates at an extremely low level for a long time now, right? And I think over the last decade, they've kind of realized, hey, we can't let interest rates sit around 0%, because if you do have some economic troubles, you don't have any bullets in your gun, right? Where are you going to take interest rates beyond 0? So now that they've got them up, 4%-ish, right? As long as they're not running into a recession, they may leave them there for a while, right? So just because you see inflation moderate doesn't mean you're going to see interest rates come back down. So keep that in mind. Now, if we do run into a recession, you could have interest rates come back down, and we would have a very sweet spot for buying real estate. Sometime I would think in the next 6 months, maybe a year, something to that effect. So basically, you want to keep an eye on this stuff, and you kind of want to know where you are in these lovely curves that I drew, right? You're never going to know exactly, right? Like even me as an economist says, hey, do we have a buying opportunity? I think we do have a buying opportunity sometime in the next 6 months, but that could be out to a year, right? Are we at A? Are we at C? Are we at X? Are we at Y? You're never really going to know until you look back in history and say, oh, okay, we were here or we were there, right? What you want to do is just make sure that you don't think you're at Y when really you're at C. right? That's the big mistake. So where are we here? I don't think we're at X yet. We're probably somewhere in between here. But I don't think we're at the bottom of the market yet. I was kind of surprised at some of the price softening that Stacy kind of alluded to. I was under the impression maybe stuff was staying on the market, but prices weren't really coming down, but it does look like we've got some softening there. And that's good. Thank God for refinancing, right? Like Stacy was saying, you want to really buy at a high price and then, or buy at a low price and then worry about the interest rate later when interest rates come down, refinance that and make it a more manageable payment, right? And the other thing to think about here is lags, right? We see inflation and the Fed doesn't do anything right away, right? It's not like, hey, inflation goes up, that's going to affect interest rates tomorrow. I got to buy 2 days from now. That's just not how it works, right? Thankfully, inflation goes up. Fed says, well, maybe we should do something about this. They meet. Okay, we're going to wait for more data. Another month goes by, inflation goes up more. Okay, we are going to do something about it. So we move it up a little bit, right? I mean, they've been raising interest rates for, 5 or 6 months now. And we're just now starting to see some softening, right? So when you see these changes, you don't have to jump right into the market today. You've got some time. Okay, so where do we stand presently, right? Things are softening up a little bit. The Swisher family is actually out looking for some real estate opportunities. I don't know if we'll get doors to rent, but my wife wants some land. There's certain parts of the state that I wouldn't mind, having a second home or the opportunity for a second home in. And so that what we're doing is I see that interest rates are going up. We're going to have a market softening. And we've started looking around and just doing our research the way you would like on an individual property or an individual equity, right? Trying to get a gauge of prices like price per acre, price per square foot in certain areas of the state, that type of thing, so that 6 months from now, as we're watching these things, we can say, okay, yes, things have softened up quite a bit. And it's time to get in, or this looks like a deal, right? That's kind of how, as an economist, I would be using that information. And what do I look for to tell where we're going, right? I look at inflation. I try and kind of watch the Fed and what they're thinking and doing. And then I try and keep an eye on the real estate market and see what those increases in interest rates are doing to prices in the market. I just kind of use that information.
Will a decrease in interest rates be a trigger for you, like a lag? You'll go, okay, rates are going down. Does that mean maybe the market softens? So maybe that would be kind of like, okay, this is a good sweet spot. Is that what you would think?
What I'm looking for is like interest rates will be going up. You will see the economy soften, and then the Fed will start to put the brakes on, right? And so I'll think this is kind of our top. We're near the top on interest rates, right? So this is probably the time right now to maybe 3-6 months from now when I'm going to get my best pricing in real estate overall, right? Like you do have individual markets and individual situations that just are better than others, regardless of the national or the macroeconomic environment, right? But when I see that top in interest rates and the economy start to turn a little bit, that's when I really want to, start pulling the trigger on investments or doing a lot of deep dives into buying properties. Does that make sense? Okay. And of course, part of that is knowing your local market. Having some comparables. 6 months ago, this type of property cost me this much per square foot, or these were my rent rates, the type of stuff that you learn here. Pick regions that make sense long-term. I think you're good in the Northwest. There's some pockets that probably aren't great, but Idaho, Washington, Oregon. These are really good places to buy. Western Montana. And then of course, just recognizing that sweet spot in terms of the macro economic environment, right? When interest rates look like they're topping out, you probably have a window there of 3, 6, maybe 9 months to really jump in and start buying. And you can use this stuff, like the house that I'm in now, I bought in 2009. I sold my first house in 2005. I knew we were in a bubble and I wanted to get out of it. Sold that house, made more money than I would have ever thought of making. Left the country for a little while, came back in 2009. I didn't think we were at the bottom, but I started looking around, right? I wanted to get back in the house. I knew things were softening, right? And I found a property that had come from 225 down to 200, which sounds ridiculous now, given the prices we were just talking about a little bit ago. That was still kind of above my affordability level, but it was getting close. And I liked the property. So I kept an eye on it. I think it came from 225 to 205. Kept an eye on it. Couple weeks later, it dropped from 205 to 198. So I knew I had an incentivized seller. I didn't think the market was at a bottom, right? So let's say I buy that property for 198 and a year later, things aren't working out job-wise and I've got to sell. I'm probably going to take a loss on that house. That's the way I was thinking. But I offered the guy 170. And of course, he came back and he's like, that's a slap in the face. You're just lowballing me, blah, 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 blah. So I wrote my realtor a letter and I gave it to him and I said, this really isn't for you. This is for the guy who's selling, right? But I'm addressing it to you and you just make sure it gets in his hands. And I basically said, like, look, a year from now, this property is not going to be worth 198. It's going to be worth 170. And these are the reasons why. And I listed out 4 or 5 reasons why the market was still going to come down. And I said, I hope to be in this house a long time. And, I'm willing to accept a short-term loss in hope for a long-term gain, right? But if something goes wrong in the next year, I want to be protected, right? So I'm not going to suck down a $30,000 loss if something goes wrong in the next year. If he's willing to split that loss with me, we can talk. A couple of days later, the guy came back, I'll meet you at 185 and got in at 185. But used the knowledge of where we were in that cycle, to negotiate and say, hey, look, I know this thing's still going down and I see you're incentivized. Let's make a deal. That type of thing. I think that was it in terms of slides.
Hey, Aaron, I got a question about
Yeah.
that amazing graph.
Uh-oh, this? Not that amazing enough? Oh.
I was gonna say with this graph, it's a great time to get your HELOC input when you're up at sea. Right? It's the market's high, so it's getting HELOC while the value is.
And the interest rates are low.
Before it goes back up. Yeah, the other one, what happened to all that money with this big shift? Because now it seems like, okay, now we'll just get on the same inflation rate. But we had like this 10x shift, like a 10x, literally 4 to 4x.
Yeah. So
That's from like the COVID in like $4 trillion like dumped into the economy or whatever, right?
yeah,
Who got all that money?
the
Where is that
government,
money?
the government spent a lot of money, right?
Yeah.
Like we had COVID relief and this is what the government does. They throw money at it. The Fed throws money at it. It's
But they're just throwing dollars at it, not really money, right? You know what I mean?
yeah, but the government spends all that money on those relief programs, right? And if the Fed doesn't do this, interest rates go through the roof. The market drives interest rates through
No,
the
I
roof,
understand
right?
that, I think, yeah.
Yeah,
I'm just wondering what happened, because now like there's like all of this extra cash. And then what happened to all of that extra cash? Because if it would have just kept going on that line, we'd be at 6 now. You know what I mean?
Yeah.
So who absorbed all that? Like Jeff Bezos, or is it
It
in
is,
our
it is to
state,
some
or-
degree still working through the economy, but because we live in an economy where you've got extreme income disparity, the Jeff Bezoses, the Bill Gateses are like, you know, if you look at just Jeff Bezos as an example, got divorced 3 years ago, 5 years ago, whatever it was, right? His wife takes half and she got like 140 billion or something, like some ungodly amount. But if you look at his wealth today, like it had, like he gave her half and he's already made it back. You know, like
Well, I'd be really interested to see how that breaks out. Like,
I've heard
where
savings
did that
are
come
up. I've
Yeah.
heard that savings are up, but then now that buyers are kind of feeling the market shifting, because we're all here, because we're all like, what's going on in the market? There's a shift. And so I feel like people are starting to clench down on it and hold their money a little bit. Is that,
But
Yeah,
there's
oh,
an
yeah, yeah.
influx, there's like this huge influx that didn't exist before, you know, and
So a huge part of it, Shane, is all
Yeah.
the government programs that they use to pay for, the COVID relief stuff.
yeah, exactly.
And then there's all this other, programs, the trillions that they've allocated for infrastructure. And everything.
Yeah.
That infrastructure money is earmarked, but it's, isn't out yet. But the government has to pay for these programs somehow.
Oh,
While they're getting record tax increases, we're still borrowing money to pay for all these programs, and what they're doing is printing money.
Yeah.
so I didn't-
Yeah.
And so they're basically taxing us by printing money, and it's trillions of dollars that they've done. And it's a way for them to pay for these programs and drive up the cost of things, but do it for free, right? They don't have to necessarily get it through revenues, they've just been printing money.
so
Yeah.
let's-
that's what
And
the cost of
corporations,
inflation.
yeah, corporations aren't stupid. I mean, they look at this stuff and they say, hey, there's a lot of extra cash floating around. Now's the time to raise some prices, right? And we'll just absorb some of that, right? So corporate profits right now are, that's where a lot of that's going.
Crazy.
Yeah.
Well, Stacy mentioned that savings grow, and yet all of us realize that our money in the bank that's getting 1 or 2%, we're only losing 6% a year on the value of our money. So I would like you to address some of those things, like the value of money and the volume of money, and how this endless printing actually devalues the money that we have. So maybe we're better off to have assets like real estate.
Right. Something that's solid, gold, real estate. Yeah. Theoretically equities, because, corporations are getting richer and profit margins are growing, that type of thing. I had a thought there that I was going, you were talking about low interest rates. Yeah. So, and those low interest rates for a long time drives everybody to equities, right? Because it doesn't make any sense to buy a bond, doesn't make any sense to have a savings account or a CD at the bank. Like, I don't even know if they do CDs anymore, right? Like,
4% right now? There's.
are they? Okay, I remember my parents having like CDs that paid 12%, and like I said, I don't even know if they exist, if CDs even exist anymore. And so it's like, if you want your money to have some sort of, if not appreciation, just holding its value, you've got to be in equities or real estate or that type of thing. Long term, I think that's not sustainable, but at this point, there is no counter economic narrative in Washington to go against that. In fact, you have a school of thought now in Washington that seems to be greatly accepted in Washington, called modern monetary theory, which basically says you can print money, the government can run deficits, and inflation will not be a problem until you exhaust the resources that the money is buying. So let's say the government was printing a bunch of money, running a bunch of debt to buy coal. You wouldn't see inflation until you ran out of the supply of coal, or until we maxed out the production of coal, and then you'd see inflation. I don't agree with that school of thought, right? But that's what people think. And part of it is because economists haven't seen any inflation, right? They haven't seen any inflation. We've been printing money out the yin yang. We haven't seen any inflation for 2 or 3 decades, right? Well, there is inflation. We're just not measuring it, right? It's in equities and housing, and we don't include that in the inflation measure. So, you've got a whole school of thought by these economists built on the fact that you're not seeing an inflation because economists aren't measuring the inflation, right? Like,
and somehow there's a relationship that maybe you can address between inflation and supply and demand. I mean, look at petroleum. And we have a son whose business depends on diesel, and he's just getting murdered. He had to take a second job on his time off to come out even. So we have these events that drive up or drive down the availability of a product.
yeah.
And so how does supply and demand mesh with inflation?
So if you had like a stable money supply, or the money supply was growing exactly at the growth rate of production, right? So you had stable prices overall. Any price increase that you saw, you would still see price increases and price decreases in the economy, but those would be based upon supply and demand, right? The demand goes up for milk, so the price of milk goes up. But because people are buying milk, they're not buying bacon, so the price of bacon goes down. But because we're printing money like this, you can have the price go up on everything, right? Because
if I get a few more cows to put more milk in the market, I can stabilize the price back down, right?
maybe not. A lot of factors would go into play there. Yeah.
So Aaron, nice presentation. Thank you. Very interesting. I'm sitting here trying to figure out what's happening with interest rates, because we're awaiting terms on a loan. Every point makes a difference to us. In the last month, the 5-year T-bills have gone from 5.4 to 4.9. Well, no, they've gone down about a half point in the last month. They've gone down. Why would that be? I've been expecting that they would go up.
So, inflation has been running 8%, a little more year over year as you measure per month. The latest measurement we had was actually sub 8. It was 7.5 maybe, or something like that. And so that, to the market, I think signals, hey, they're getting inflation under control. And so you might see a dip in inflation. What will that measurement be next month? It could be back up above 8, and then the drop that you see is now evaporated, and those bills are back up to where they were before.
Yes, I was wondering if we should wait another week, but you don't really know that for me here.
Yeah, you don't. Yeah, you don't know what. I tend to think we will see inflation come down. I think unless the Fed really screws it up, I don't see a major recession. And so, it's not going to be like a 2008 was an anomaly, right? Like, you're not going to have a market like that again. I think you'll see some moderation in prices, right? Some softening, and there's going to be a sweet spot. It may even stay. You may even have a sweet spot for a fairly long period of time. But I don't think, if everybody plays their cards right, I don't think we're going into a recession. what that means is that you're probably going to see interest rates maybe stay 4 or 5% on a federal funds rate. You know, your mortgage rates are probably going to stay 8, 9%, you know, for a while.
Thanks.
Any other questions? Yeah, go ahead.
Okay, I appreciated that you had said that we'd had an 8% of inflation for a while.
Mhm.
Because what I think about also is how to budget for inflation in the future. You know, for folks who are buying real estate as part of a retirement plan. How much cash do we need to retire? Well, we know how much cash we need to live on today.
Mhm.
What are your thoughts on that?
And inflation in the long run, so to speak.
Well, I guess that's what it would be, really. Isn't that really my question? If I want to know how much cash I need in 20 years to live on, is that what I'm looking at, inflation?
Yeah. Because the macroeconomic environment that has given us 2 or 3 decades of low inflation in consumer goods, bread, milk, you know, that type of thing, is not being remedied, and so will probably be maintained for the near future. And that should keep inflation on consumer goods low. That does mean probably that you're going to see a lot of inflation on equities, housing prices, maybe college tuition, things of that sort, right? But there really isn't the demand in the marketplace from most of the population to drive inflation in the long run, right? People's wages just aren't that good. Most of the money is going to go to the folks at the top, and you're going to see the inflation where they spend their money. Gold, precious metals, fine arts, equities, housing, buying up water companies or something about it, you know, that type of thing. So I think long-term, the inflation outlook is actually pretty good, not for good reasons, but you know, it should be pretty low.
So if you were planning how much cash you needed to retire and live on in the future, would you use a number like 8% or 10% or?
I'm not sure I have a good answer for you.
Fair enough.
Yeah. If you ask my wife, she'd say all the money. But yeah, if you're looking for like a long-term inflation figure that you're adding in, I would shoot maybe for like a 4 or 5%. I don't think it'll stay up high enough, 8%. You know, the Fed thinking that they can keep it down around 2 might be a little unrealistic. Yeah. You know, give yourself, I think inflation will probably be lower than that, but I'd give myself a little cushion.
Yeah.
Right? Like maybe 3% is what I would expect, but I would give myself 4 or 5, you know, in my budgeting.
That's what the financial planner said too, but.
Okay. Yeah. Anybody else? Thank you guys for
Thank you.
letting me come to that.
Don't go yet. Don't go
Okay.
yet.
Uh-oh.
All right, guys, come here.
Okay.
I'm gonna just kind of do a little highlights. Like, this was
Okay.
amazing. Thank you.
Mhm.
I took notes, and so here we had Aaron Swisher, a macroeconomist. I'm StacyA McBain with Swope Investment Properties. We're at AVID Investors Club, and here are some of the things that I really starred on my notes. I really valued the way you gave us a high-level lesson. I think you said that inflation is basically money versus production. And when you apply everything you know about inflation and boil it down, we've been at around 8%. You don't think we're at the bottom yet. And maybe, who knows, in terms of what we might apply, it seems like maybe in 6 months, we have some different opportunities. It is time, if you're ever considering buying in the next little while, it's time to at least really start doing your research. That's
Do
what
your
our
homework, start doing your homework now, right?
Mhm.
Yes, absolutely.
get
Yeah.
your baseline so
Yeah.
you know what things are costing, you know a good deal when you spot it.
Right.
And And then maybe if you're really trying to time the market, you know, when the Feds puts the brakes on and on inflation, that's maybe when we might start to see the best, absolute best pricing. And that would be like the ideal time to pull a trigger on something. But in general, keeping money in real estate and gold and equities, those are good inflation-proof types of investments.
And I assume everybody here is investors, right? Nobody here is out looking for their dream home, I'm guessing, right? Like if you saw your dream home right now and it was just everything you loved, right? Like, don't wait 6 months for lower prices, right? Somebody might jump in there and scoop your dream home, right? But if you're thinking about investing, that's kind of a different decision, right? You know, you don't
Yeah.
necessarily need that property. It's not your dream home.
You're right. We're talking from an investor perspective,
Yeah.
but when you need a place to live, you need a place to live. And
Yeah,
the time to
yeah.
buy is when you've got the money to buy, you've got the desire to buy, you can afford it.
Yeah.
And so, yeah, that is a whole different story. And that's who right now a lot of my clients are. You know, some of our friends are my clients. Right now, my investor clients are kind of just sort of waiting to see what's happening, which is why we brought you out here and why we're putting this together.
But people who need a home need a home.
Exactly. But the really big thing that I was noticing is something you said at the beginning. You said basically play a market for its strengths. All markets have some sort of opportunity built in,
Mhm.
and that individual market is going to present a diamond in the rough. And if that diamond in the rough is for you, play the market for its strengths and grab it
Yeah,
and
Yeah.
make the economy work for you.
yeah. Yeah,
Aaron Swisher, AVID Investors, thank you so much.
you got it. We got it. Thank you all.